What's going on? Okay, today I wanted to take a quick look at a sensitivity analysis in order to kind of demonstrate a hypothetical situation in a changing economy, a slowing economy, basically a moving economy. I thought this would be a good way to demonstrate the relationship between the cap rate, the value, and the NOI. So let's start by taking a look at the actual equations. Um, I like to use this handy little triangle, this like algebra chart that I learned in probably elementary school. And if you do this, it makes it really easy to remember how all of these different things, these different metrics interact with each other. So on the left-hand side here, this little chart, you can see cap rate equals NOI divided by value. And if I look at my triangle, I have my cap rate here. Solve for cap rate, you get NOI over value. So same thing. Then if I'm solving for value, I have NOI, net operating income, over my cap rate. And if you have your NOI, your net operating income, that would be your cap rate times your value. So for me, as long as I remember the NOI is always on top, it's easy to kind of figure out these different equations to go through and do these types of analysis. Because as you know, these metrics are very important towards multifamily and commercial real estate in general. Your net operating income, that's your income after your expenses. You've got your cap rate, which is essentially a way to value a property, and the actual value, which is the what the asset is worth. So those three things combined, it's a pretty easy way to look at everything. So now that we got that out of the way, I'll keep these to the side so you can see them. But let's go through. Again, this is a hypothetical situation. None of this actually happened, but it's a very easy, you could see it happening. I'm not saying it's going to happen. I'm not predicting it's going to go this way or not, but just a hypothetical situation. Okay, so let's go through. Right now, it's February of 2023. We have all sorts of different things happening. We have a worsening economy overall. We've seen a lot of layoffs, especially in the tech industry right now. So higher end jobs seem to be getting laid off. Because of that, you could essentially assume there's going to be a lower demand for high-end housing, and maybe those same people would go down to mid-range housing. So there's not going to be a lower demand for all types of housing, but let's just say there's a lower demand for high-end apartments right now, which could lead to stagnant or even lowering rents, which would in turn lower your NOI, which would lower your value. While all of this is happening, we have higher inflation. We all know that the Fed has been increasing inflation and are increasing interest rates, which has been increasing inflation, which also leads to a lower NOI because increase in inflation means increased expenses. And all of this, higher interest rates, everything leads to a decompression of cap rates, meaning cap rates are going up, which lowers your value. Okay. So let's assume you bought a apartment building in Q3 of 2021 for $10 million. Everything looks good. The outlook on the economy looks good. Rents have been increasing double digits for like a year and a half now. Pretty much anybody could go into an apartment building and make money. You didn't even really have to follow a business plan. There's plenty of people that were buying on bridge and flipping up an apartment within like a year and a half. So let's assume you're trying to do something like that. Okay, we're going through. Again, it's Q3 of 2021. We have a net operating income at the purchase of $500,000. We bought at a cap rate of 5. That gives you a value of $10 million. And we go through that. So again, you can look at your value of 10 million and divide your NOI by your cap rate. And that's how we got to that. So, okay, everything looks good. You're like, yes, bought an apartment building. I syndicated it. I joint ventured it, whatever. Bought a building. It's worth $10 million. I'm going to make loads of money now. But we go a year later. So now it's 2020, or it's Q3 of 2022. And your NOI went down $25,000. This was a combination of higher vacancy, you had some bad debt, you had people, your tenants were not all paying their rent. They weren't paying their fees, like their water fees, their utility fees, media fees, pet fees, whatever it might be. And some of your expenses like repairs and maintenance went up because the price of materials went up. Same with your CapEx. There's a shortage of labor, so the labor price has gone up. And insurance has been going up. We all know those things are real and those have been happening. Because of that, Q3 2022, your NOI went from 500,000 down to 475,000. Your cap rate stayed the same. But because of that drop in NOI and going through our equation again, you actually lost $500,000 worth of value on your property. So, and we did that just by looking at this value equation again, NOI divided by cap rate. Okay, so we're going through, that's 1 year of ownership. And, that doesn't necessarily mean you were losing money, quarterly. You might have still been having positive cash flow, but the overall value of the property has dropped. So let's continue on this track. We have some higher vacancy. So you end up deciding that instead of increasing your rents like you would typically do, and like you probably did on your pro forma, especially looking at the past year and a half or 2 years, you stagnate them, you leave them level. And you even give away some concessions in the form of like a month's free rent, whatever else, in order to try to increase your occupancy. And it works. You increase your occupancy, but the concessions overall, actually, you just end up dropping your NOI another $10,000. I know that may not be realistic, but just assume so for this. So here we are. We're down to $475,000 in NOI with the same 5% cap rate. And you've actually lost a total of $700,000 on this property so far, if you're looking at the value alone. And again, that's just going through our equation. Rate here, value is NOI divided by cap rate. Cap rate stayed the same, 5% these 2 years. And our NOI has been steadily dropping. So that means we've steadily dropped the value of our property. Let's just drag this down so we have it next to us, in case you're not super familiar with those equations. Okay, so on top of the NOI dropping, cap rates in your area are also expanding due to increasing interest rates and lower demand from purchasers of properties. That has been happening. We've seen the Fed increasing rates, a 1/4% here, 0.5% here. It's been going on for a couple months now, and we're still expecting it to happen for at least another 2-3 months, possibly more, possibly less. It depends who you talk to. Nobody quite knows, but they definitely want to get rid of the crazy inflation that we've been having. So there is a real possibility that rates are going to continue to go up for at least another number of months. So we're still in the same time as that last part of the example. We're still in Q3 of 2022. Our NOI this time stayed the same, but our cap rate actually went up 0.5%, so to 5.5. Now, if we go through and we do our value again, we do our NOI divided by our cap rate, you can see that we've actually dropped quite a bit this time. We're down to a value of around $8.5 million, which means we've lost about $1.5 million of value from our original $10,000 purchase price. So that seems pretty grim. It seems like you're definitely, you're losing. You're not doing what you wanted to. Things aren't going as planned. So I guess the next question is, does this really matter if you're not selling? And I think really, it depends. If you're not selling the property, then this is just a paper loss. But it does matter in a number of different circumstances. So here's a couple that I have that are very real and that have been happening to people and are going to happen to people this coming year, as I would think. If you went into a building back 1.5 years ago, 2 years ago, and you had floating rate debt, if you had bridge debt, if you had any sort of floating rate debt, and you did not buy a sufficient rate cap, now you might need to refinance or sell. And your property's got to drop to NOI and increased cap rate. That means you could sell you're going to sell at a loss. Your expenses outweigh your income. So obviously, yeah, it matters that your value's dropping. If you don't have cash on hand, that's bad. You might need to do a capital call with investors, or you might need to put in some of your own money, or a combination of both. So yes, it matters, this drop in value, if you're already struggling with the asset, if you have poor management in place, if you have poor asset management in place, if you're not following your business plan, if you're not tracking your metrics, if you're seeing a steady increase in bad debt and non-payment, if you're seeing a steady increase in vacancy, all of these things are bad. Now, this paper loss may not be bad if you have enough money on hand, you have the reserves, you have the cash in the bank, you're able to cover everything still. If it's still cash flowing and it's covering your expenses, all of this might not be bad. It's just a paper loss, and we're going to hold through this market cycle. So that's the place you want to be in if you've dropped in value, or even if you haven't dropped in value, if your property has stayed stagnant, if it's increased in value, you want to be in this position where you're just doing paper gains or losses on the value itself, and you're going to hold through the market cycle, or even sell in this cycle because your property's doing just fine. So let's continue on this trek a little bit farther along, and let's assume that it's another year later now. Things are on the up and up. You've been able to remove your concessions. You've increased your occupancy. Your average rents are going up. And look at this, your NOI back where you started. So we're in the future now. It's Q3 of 2023. We bought the property with $500,000 NOI, and we're now back at $500,000 NOI. We were able to make up that shortfall of from 465,000 all the way back to 500,000 where we started. But the cap rate is still higher than where we purchased it. So although we're doing better than we were doing a year ago, we still have a paper loss of about $900,000, but things are looking good, relatively good. So we're going to go another year into the future. We're in Q3 of 2024. Rates are coming down. Your interest rates are coming down, which is going to overall end up decreasing your cap rate because people are able to borrow money at a lower rate, which means they can pay more and are willing to pay more. There's less hesitation in the market. There's less fear, and you've been able to increase your NOI. So things are continuing to look good. You've actually increased your NOI $25,000. So you're at $525,000, and the cap rate went back down to 5%, which is where you actually purchased the property. So look at that. You're in the green. You're $500,000 in the green. And you can see things are going well. You and your team are happy with how everything's going, and you're happy with what's happening at your property. You're following your business plan. Your property manager's doing well. They've been able to remedy all of the issues that you had, and it's going steadily. So let's look another year into the future. We're in Q3 of 2025 at this point. The inflationary period has ended. I guess the Fed fixed it. Who the hell knows? Cap rates have continued to compress due to this, and jobs are plentiful. Because of this, salaries have been increasing. There's a high demand for nice apartments in good areas. This could mean A apartments. This could be B. It doesn't really matter for this example. But we've increased another $25,000 on our NOI, being a total of $550,000. And look at that, we're at a 4.5 cap rate. And that means we've increased the value almost $2 million and $2.2 million. That's awesome. That's good. That's what we want to see. That's why you're kind of in this game, right? And now it's 5 years since the purchase. I chose 5 because for a lot of people, especially in the syndication space, 5 years is kind of that sweet spot. People hold, a lot of times the business plans hold for somewhere around 3 to 5 years. So let's say we're 5 years into the future and you've progressed according to the business plan, and look at that, the market cycle's actually in your favor. It's becoming a seller's market again. So you're at Q3 of 2025. You've increased your NOI $75,000 since purchasing the property. You're at $575,000 total. The cap rate has continued to decrease, as we said. So we're at 4.25. And that means our value, NOI divided by cap rate, equals $13.5 million. That means you've increased the value $3.5 million on this deal. That's huge. So like I thought this was a useful example because it shows the relationship between the cap rate, the NOI, and the value of a deal and how important it is to look at everything. So when you go into a property, you need to do a sensitivity analysis and you can't assume that the cap rate's going to continue to decompress and get smaller and smaller, increasing your value for doing essentially nothing, for just being in the right market at the right place at the right time. Don't assume that. One of the things we do when we're underwriting is we actually increase the cap rate for our sale, for our exit. So things that you need to do, I think the conclusion and what you should be learning from this example, from this whatever, is buy right in the beginning. Do a conservative underwriting. Make sure that you're looking at your cap rate you're actually increasing it, maybe 0.1% per year. Maybe it's 20.2% per year. That's what I'm doing right now, just because we have a little more uncertainty, going 0.2% per year increase. Some people are doing more, some people are doing less. It depends how conservative you want to be and your market and your asset type and et cetera, et cetera, et cetera. So also, you need to have a great business plan from the beginning, from the get-go, before you even purchase this thing, and you need to be able to execute it. That means your property manager has to be willing to follow this plan. They have to be on board, and both of you have to have a mutual understanding of how it's going to get done and if it's going to be able to get done. If your property manager from the beginning says, no, this is going to be impossible to do based on the building, based on the amount of money you have in your CapEx reserve, based on the location, whatever it might be, then don't think that you're going to be able to make it happen if your team isn't on board to help make it happen. The whole team's got to be on board to make this happen. Not only that, but you need to track everything. Your asset management team or person needs to be able to look at all of the metrics that you're getting from your property manager and see, are we trending in the right direction? Your asset manager needs to make sure that the business plan is being executed and followed by the property manager. You guys need to work together to get all of that done. And you need to track your occupancy. You need to track your vacancy. You need to track how long it takes from a tenant moving out to turn the entire unit. That means how long does it take to clean the unit? How long does it take to market the unit? How long does it take to get a new person in? And go from there. You need all of the metrics. You want to look at your P&L often. You want to know what's being spent, how all of your money is being spent, where you're making money, who's paying, who's not paying. Is everybody paying their fees? You need to know your comps in the area. Are you high or low? Are you in a good position? And all of that comes to be conservative, be safe, especially during uncertain times. So who knows? We're certainly in a slowing economy right now, but we don't know how long we're going to be here. So just underwrite properly, understand the relationship between the NOI, the cap rate, and the value, and then be able to execute on everything. So I hope this was helpful. I hope this was a good way to kind of learn that relationship between those three metrics and see how things can change and adjust and move around over 5 years in this hypothetical situation. If it was helpful, let me know. Like, subscribe. I'm going to try to put more of these videos out that are able to help, especially beginner investors and people on the LP side, understand exactly what's going on. So cheers. Thank you.